the divestiture and the debt reduction initiatives or mandates, however you want to call it, that is being born from a lot of these mergers by public E&P companies. Are we going to see more of this, you think? Rationalizations of minerals and non-op in these publicly traded companies for balance sheet maintenance? Over to you.
I think there's sort of individual cases where there's going to be some of these divestitures. Historically, they had been more from the oil majors, and there was sort of this joke where you can't lose money if you're buying from Shell, or you can't lose money if you're buying from Exxon. Like they would just divest smaller assets at prices that were very low because it was just uneconomic for their large organizations to try to manage, 1,000 wells in West Texas or whatever. And so, they would price it at a price just to make sure they would sell it and then offload the liability. They're very concerned with the buyers staying in business, so that way they wouldn't get that liability back to them. But otherwise, they just sort of would get a bunch of stuff out the door. It seems like Apache and maybe Oxy are sort of following in those footsteps, which is a little weird because they are smaller than the Exxons and Chevrons and Shells. But some of these deals I think are really good for the buyers. And so good for them. And then for the non-op and mineral guys, if they're able to come in and pick off some assets and get them at a relative discount versus where they could buy them otherwise, and where they could leverage a balance sheet like being private equity backed or leverage a public balance sheet or so on, good for them. That's a competitive advantage. They could potentially earn an above market return.